There is a strange pattern in almost every economy on Earth. Most people work for decades. They earn more as the years pass, and yet only a small fraction of them ever become wealthy. It's tempting to explain that gap with effort, or luck, or intelligence, but none of those fully account for it, because wealth doesn't behave like a reward for hard work. It behaves like a system, one with rules that almost no one is taught. To see that system, we have to start with the thing nearly everyone believes is the answer. Income. A bigger salary. A better job. A higher rate for your time. And this belief is reasonable. Income is real money, and more of it clearly helps. So the plan looks obvious. Earn more, and wealth should follow. But here's the first crack in that idea. If income by itself created wealth, then the highest earners would always be the wealthiest people. In reality, plenty of people who earn a great deal own almost nothing. The money arrives, and then it quietly disappears. To understand where it goes, we have to follow a single paycheck. When income lands, it doesn't sit still. It immediately meets a wall of outflows. Rent, food, transport, the ordinary cost of simply being alive. Whatever those outflows don't swallow is the only part of the paycheck that ever had a chance to become wealth. That leftover slice has a name. It's called the savings rate, and it turns out to matter far more than the size of the paycheck itself. This is why raises so often change nothing. When income goes up, spending usually rises to meet it. The paycheck gets bigger, but so does the life attached to it, and the gap between what comes in and what stays behind barely moves at all. The person feels more successful, but the machine underneath them is still running in place. So the real dividing line was never how much someone earns. It's how much they keep. Two people can earn the exact same amount, and the one who holds a wider gap between earning and spending will pull ahead year after year. But keeping money is only the first step, because money that simply sits still has a quiet problem of its own. Cash, on its own, does nothing. It doesn't grow, and it doesn't work. For that kept money to build wealth, it has to be converted into something else, a productive asset. And a productive asset is anything that generates value while you aren't touching it. A share of a business, property that earns rent, a fund that quietly holds hundreds of companies at once. The distinction is simple, and it's the whole game. You work for income. Assets work for you. This is the hinge the entire system turns on. Income is time traded for money, and your time runs out a little more each day. An asset breaks that trade completely. It produces a return without asking for your hours in exchange. So the wealthy are not always earning more per hour than everyone else. They've simply built a second source of money that doesn't depend on their hours at all. And once an asset exists, something unusual starts to happen to it. The return it produces can be reinvested, used to buy a little more of the asset. Now the asset is slightly larger, so its next return is slightly larger too. That return gets reinvested again. This loop, where growth begins to feed on its own growth, is called compounding. Compounding is deceptive because at the start it looks like almost nothing. For years, the growth feels small, sometimes even disappointing. Then the line begins to bend upward, and eventually it climbs almost straight into the sky. The early years feel empty. The later years are where nearly all of the wealth actually appears, which points directly to the one ingredient compounding cannot survive without. That ingredient is time. Compounding isn't really powered by large amounts of money. It's powered by long stretches of it. A modest sum given decades will usually outgrow a large sum given only a few years. This is why starting early matters so much more than starting big. The single most valuable input in the entire system isn't income at all. It's time, and time is the one thing you can never buy back. So now we can see why the system quietly fails for so many people, even when they earn well. The first leak is lifestyle inflation. As income grows, the standard of living expands to match it. A nicer car, a larger home, upgraded everything. None of it is wrong, and none of it feels reckless. But each upgrade widens the outflow and shrinks the slice left over to become assets. The reward for earning more often turns out to be nothing more than a more expensive life. The second leak runs in the opposite direction, and it's far more dangerous. Debt is compounding pointed straight back at you. The same mathematics that grows an asset also grows what you owe, except now it's working for someone else, pulling money out of your life every single month. High-interest debt can erase the returns from good assets faster than those assets can ever build them. One side of the equation quietly draining the other. And underneath all of it sits a force that no one chooses and no one escapes. Inflation. Every year, prices tend to drift upward, which means each unit of money buys a little less than it did the year before. Money left sitting as cash isn't holding steady. It's slowly losing ground. This is the part that surprises people the most. Doing nothing with your money is not the safe option. It's a slow, almost guaranteed decline. What inflation is really eroding is purchasing power, not the number in the account, but what that number can actually buy. And this is the hidden reason productive assets matter so much. Assets tend to rise along with prices, and often faster than them. So while cash quietly loses purchasing power in the background, a well-chosen asset can outrun inflation and build real wealth on top of it. The choice was never between risk and safety. It was between slow, certain loss and managed growth. But a productive asset rarely climbs in a smooth, straight line. Markets move in cycles: recession, recovery, boom, and correction, repeating in a rhythm no one can perfectly predict. From one day to the next, the value of an asset can dip, and on the surface those small declines can feel like something going wrong. Yet a single day is the wrong lens to judge it by. Zoom out across decades, and the tiny daily drops almost disappear into a long curve that keeps climbing. The short-term line is noise, and the long-term trend is the signal. Seen across days, an asset can look fragile. Seen across decades, that same asset looks almost inevitable. This is where most people quietly lose, not by choosing the wrong asset, but by reacting to the wrong time frame. When fear rises during a downturn, they sell, or they stop investing altogether, and that short-term retreat is what actually does the damage. Because a temporary decline is not only survivable, it is often the very moment of opportunity. The patient investor who keeps going while others hesitate is simply staying in the market long enough for compounding to do its work. Which brings us to the strangest part of the whole system. It isn't limited by knowledge. Most of these ideas are simple. The real constraint is behavior. Compounding rewards patience, and human beings are wired for the immediate. It asks you to hold a gap between earning and spending for years, long before any payoff becomes visible. The math is easy. Living the math, quietly, across a long stretch of time, is the hard part. And that is where almost all of the difference is really decided. So when we step back, the whole picture reorganizes itself. Wealth was never a single dramatic event. Not a windfall, not a salary, not one lucky break. It's the slow output of a system. A gap between earning and spending, converted into productive assets, left to compound across enough time, and protected along the way from the leaks of lifestyle inflation, debt, and inflation. And that reframes what income really is. Income isn't wealth. Income is the raw material. It's what gives you something to convert in the first place. Income creates the opportunity, but it's the assets quietly working in the background across years you can never get back that turn that opportunity into wealth. Which is why two people can walk the very same road, earn the very same money, and still arrive at completely different places. One of them spent their income. The other used it to buy the system.